Silver just changed who sets the price, and the new boss is the Asian physical market, not London's paper plumbing. On December 29th, 2025, you watched it happen in real time. Silver ripped to an all-time high near the mid-80s, then dumped hard into the mid-70s like someone pulled a lever. That kind of tape isn't random volatility. It's a jurisdiction fight. It is the old benchmark center trying to keep the lid on while the real clearing price starts printing somewhere else. And the hidden mechanism most people missed isn't a headline, it's the plumbing. When regional premiums and front-end spreads refuse to behave, spot becomes a suggestion and physical becomes the judge. Stay with me, because later in this video, I am going to give you the exact checklist for the next 1 to 2 weeks. What levels matter, what confirms the shift, what would invalidate it, and the one metric that tells you whether this is a controlled retest or the start of a continuation squeeze that gaps when you least expect it. And that's where the real pressure starts. The chart is what everyone saw. Silver going vertical, pulling the entire metals complex into a year-end fever. But the move that matters is where the last buyer is willing to overpay when liquidity thins. Because price discovery isn't the number on your screen. Price discovery is the place where a serious buyer can actually source metal, settle it, and sleep at night. When that place changes, everything downstream changes. Spreads, lease rates, inventory behavior, even how fast pullbacks get bought. But that's not the part that matters yet. The part that matters is this. A market can look liquid right up until the moment deliverable liquidity disappears. And silver is uniquely brutal here, because it lives at the intersection of two worlds that hate each other. On one side, you have the paper world, futures, OTC forwards, netting, rolling, all settle in cash, assumptions, and a whole ecosystem built on the idea that most positions never need metal. On the other side, you have the physical world, industrial procurement, refiner schedules, bar formats, shipping windows, financing lines, and the simple reality that at the end of the chain, somebody needs silver in a specific form, in a specific place, by a specific date. When those two worlds stop agreeing, the center loses control, not because of drama, but because of math. This move isn't emotion, it's math. And the next detail is what flips the whole setup. If you want the cleanest tell that price discovery is shifting, don't start with headlines and don't start with the spot print. Start with the street symptom. Where are people paying more than they should, and why are they doing it anyway? In late December, reports of unusually large physical premiums in Asia, especially against Western reference prices, started to circulate alongside signs of tightening exchange inventories in the region. You don't need to worship any one data point to understand the signal. Think like a merchant. If Shanghai is consistently paying a different price than the West, that's not noise. It's the market voting with settlement. It means the marginal buyer in that region is not satisfied by paper exposure. They want metal that clears locally. And if they're willing to pay an irrational premium to get it, it's not irrational at all. It's a scarcity fee for time, certainty, and logistics. Because if this one level breaks, the math changes. Here's the underappreciated mechanism that reframes everything. It is not how much silver exists. It's how much silver can clear right now in deliverable form without blowing up someone else's balance sheet. You can have huge headline inventory numbers and still have a deliverable crunch. Because not all inventory is equal. Some is earmarked, some is tied up in ETFs. Some is sitting in bar forms that don't match what the next buyer needs. Some is pledged as collateral. Some is simply not for sale at any reasonable price because it's strategic stock. And some inventory exists in one geography while the demand shock is happening in another. That's the hidden detail. And once you see that, you stop being surprised by record highs followed by a violent flush. That flush is not the thesis dying. It's leverage being forced out while physical demand keeps pulling quietly underneath. But that's not the part that matters. The part that matters is what the market is forced to do next. In a clean textbook world, a big premium in Asia would get instantly arbitraged. Traders would buy silver where it's cheap, ship it where it's expensive, and pocket the spread until the gap closes. That's the story people repeat to reassure themselves that any premium is temporary. But silver isn't a clean world, and this year-end window is the worst time to pretend it is. Arbitrage in physical metals is not clicking a button. It's a chain with weak links. First, you need the right kind of supply, good delivery bars, in the right custody, in the right jurisdiction. Then you need financing that doesn't get yanked when volatility spikes. Then you need a refiner slot if the bar format needs conversion. Then you need insurance, shipping, and time. Then you need customs and regulatory compliance. Then you need local clearing rules and delivery acceptance. Every one of those steps is a friction. And in a moment where price is moving 10% in a day, frictions become walls. That's why the premium can persist long enough to matter. And when it persists, the benchmark loses its authority, because the benchmark is supposed to be the price that clears everywhere. If it doesn't clear in the place where the marginal physical buyer is screaming, then it's not the clearing price anymore. And that's where the real pressure starts. Now zoom into market structure, because this is where the truth leaks out before it shows up in clean headlines. Spot prices can lie for days, spreads can't lie for long. Spreads are where delivery stress shows up first, because spreads are about time and availability. When the front end tightens, when the nearby months hold firm, when the cost of carrying metal changes, when the market starts paying for immediacy, you're seeing the system price scarcity of deliverable supply. If you've never thought about silver in terms of term structure, here's the simple translation. If it becomes expensive to get metal now relative to later, the market is telling you immediacy has value. That's not sentiment, that's logistics and inventory. And once the market starts paying for immediacy, you get a cascade of forced behaviors. Dealers become cautious lending metal. Lease and borrow costs can rise because nobody wants to part with physical when volatility is extreme. Shorts become more nervous because roll it becomes less comfortable when the front end tightens. And longs become more stubborn because they sense the squeeze potential in the system, even if they never say that out loud. But that's not the part that matters. The part that matters is the calendar. The calendar is the catalyst. End of year is when liquidity thins and stress concentrates. You have funds locking in performance, reducing risk, addressing books, and managing exposure into a date when they do not want surprises. You have commodity index rebalancing flows that are mechanical, not emotional, and those flows can collide with a market that is already stretched. You have option expiries and futures rolls that compress activity into narrow windows, and you have exchanges and clearinghouses watching volatility and saying, we're going to protect ourselves, which is polite language for we're raising margins. That's not a conspiracy, it's risk management. But the effect is dramatic, because when margins jump, the market doesn't ask you if your thesis is right, it asks if you can post collateral. If you can't, you sell. If enough people have to sell at once, you get the kind of air pocket you just saw today. Up hard, then down hard. And that's where people get emotionally manipulated. But we'll get to that, because it's the difference between surviving this tape and becoming the tape. On the margin story specifically, the mechanics are simple and brutal. When an exchange raises margin requirements in a vertical market, leveraged longs and leveraged shorts both feel pressure, but the marginal forced seller is usually the participant who was right about direction but wrong about sizing. A margin hike doesn't change fundamentals, it changes who can stay in the game. It pushes out weak hands, it forces liquidations, it creates sudden downdrafts, and then it hands the best entries to the strongest balance sheets. And in silver, strong balance sheets aren't just hedge funds. They're also industrial buyers and well-capitalized desks that can warehouse risk. That is why you can see a day where price dumps double digits, and yet premiums in physical channels tend to collapse the same way. Because one market is deleveraging paper exposure, and the other market is still negotiating for metal. And that was the next detail that flips the whole setup. Price can fall while tightness persists. Now let housing just address the London lost control part of your title without turning it into cartoonish conspiracy. London's dominance has always been a settlement story. London is an OTC hub with deep netting, huge historical infrastructure, and conventions that let large flows clear efficiently most of the time. But control in markets is always conditional. It depends on participants believing the reference price will clear across geographies with manageable friction. When a large consuming region starts prioritizing local settlement, local inventories, and local certainty, you don't need anyone to announce a revolution. The revolution happens quietly through behavior. Buyers stop trusting that paper exposure equals real access. Sellers stop being eager to lease out physical. Arbitrage stops being frictionless. And then the benchmark becomes less of a command center and more of a lagging indicator. Everyone's watching the headline, but the signal is somewhere else. The signal is the divergence, when regional physical pricing refuses to obediently follow the paper print. And when spreads begin to reflect stress that shouldn't, or T, be there in a well-supplied world. That's the supply chain veto, not because supply disappeared overnight, but because supply cannot be mobilized overnight in the form and location demanded. Silver isn't like flipping a switch on a tech product. It's mined, often as a byproduct, refined, fabricated, distributed, and financed. Each step has lead times. Many producers don't ramp because silver rips. They ramp because the primary metal economics change. Recycling helps, but recycling doesn't magically scale in a quarter just because the price spiked. Collection and processing take time. Refining capacity isn't infinite. Bar conversion isn't instant, and shipping is not teleportation. So when a sudden demand wave hits, whether investment demand, industrial procurement, or both, the pipeline can't sprint. It can only strain. And when it strains, the premium is the scream. But that's not the part that matters. The part that matters is why now, specifically right now, into this exact week. Start stacking the why now triggers like a prosecutor stacking evidence. First, we're at year end, which compresses risk management decisions into a narrow window and reduces liquidity. Thin liquidity turns normal orders into price events. Second, we've had a massive year-to-date move. Silver is up dramatically in 2025 by many measures, so there is profit to take and leverage to trim. That creates the ingredients for violent flushes. Third, there have been credible reports and market chatter about policy and trade flow constraints affecting critical materials, and in this environment, even the perception of export restrictions can force procurement behavior to front-run the risk. If a buyer believes availability could tighten on January 1st, they don't wait for confirmation. They lock supply now. Fourth, the industrial story is not theoretical anymore. Silver sits at the heart of electrification, solar deployment, EV supply chains, high-density electronics, and the build-out of data center infrastructure. When investment demand and industrial demand synchronize, the market behaves differently. Fifth, institutional flows matter. When large pools shift toward hard assets, whether because inflation expectations are sticky, real rates are wobbling, trust in fiat stability is eroding, silver gets pulled not as a curiosity, but as a portfolio component. And unlike gold, silver's market is smaller and more volatile, so the same flow has a larger price impact. Stack those five, and the tape you saw today becomes less mysterious. But that's not the part that matters. The part that matters is what the spread is telling you about the next week or two. Here's the practical way to think about price discovery move to Asia. It doesn't mean London disappears. It means London stops being the place where the marginal clearing price is set during stress. During calm periods, benchmarks converge and everyone pretends there is one global price. During stress, price fractures into local truths. Asia can become the magnet if it rests where physical demand is most inelastic, meaning they must buy even if price is high, and where settlement preference is strongest. If that's happening, you'll see it in a handful of recurring symptoms. 1. Persistent regional premium behavior, especially during pullbacks. If silver dumps in New York and the premium in Asia stays firm or widens, that's a tell. 2. Inventory behavior in regional exchanges. If reported exchange stocks in Asia remain tight or trend down even as global headlines talk about higher vault holdings, that's a tell. 3. Borrowing tone. When it becomes expensive or difficult to borrow physical silver for shorting or arbitrage, the system is signaling scarcity of lendable metal, not necessarily scarcity of metal on Earth. 4. Front-end spread behavior. When the market pays up for nearby delivery or tightens carry, it's telling you immediacy is valuable. 5. Retail and wholesale availability symptoms, fabrication delays, higher premiums in coins and small bars, industrial procurement commentary. These are imperfect, but when they align, they form a proof stack. And proof stacking is everything in a market like this, because one data point will lie to you. 5 will usually tell the truth. But that's not the part that matters. The part that matters is how the market will try to break your psychology next. Because this is where retail investors get harvested, not by some villain in a dark room, but by the natural incentives of market structure. When a market goes parabolic, volatility becomes a weapon, even if nobody intends it. It forces margin calls. It triggers stops. It induces FOMO at highs and panic at lows. It makes people confuse noise for signal. And in a jurisdiction shift story like this, the noise will be vicious. You will see days where silver looks like it's dying, only to rip again when the physical bid asserts itself. You will see headlines weaponized in both directions. One day it will be bubble. The next it will be shortage. Both can be emotionally true and analytically useless. The shield is simple. Separate the thesis from the entry. The thesis is about structural mechanics, premiums, inventories, spreads, and procurement behavior. The entry is about timing and risk. You can be right on thesis and still get destroyed on entry if you size like a gambler. Because if this one level breaks, the math changes. Not the macro math, the personal math of your account. So let's translate a technical concept into so what terms. If premiums are the scream and spreads are the lie detector, then spot is the stage. Spot is where drama happens. Spreads are where decisions happen. Premiums are where reality happens. And your job as a viewer is to watch reality, not drama. But that's not the part that matters. The part that matters is the next 1 to 2 weeks roadmap, because this is where you either confirm the power shift or you learn it was overstated. Here are the levels and the checklist in plain language, and I'm going to keep it concrete without pretending we have divine precision. Silver printed an extreme high in the low to mid 80s today, then fell back toward the mid 70s. In a market like this, the first battlefield is the post-spike acceptance zone. If price can hold above the psychologically important $70 area on pullbacks and reclaim the mid-70s quickly after flushes, that's strength. If it loses $70 cleanly and starts spending time in the mid-60s, that's not automatically the end, but it changes the short-term posture from continuation to rebuild. The next battlefield is the prior high zone around 80 to 84. If price retests that zone and gets rejected violently while premiums and spreads soften, that would argue the move was more leverage-driven and less structural. But if price retests and you see the physical signals stay tight, premiums stay elevated, inventories remain strained, borrowing tone stays firm, then the rejection becomes less meaningful. It becomes a pause in a larger shift. And if price breaks and accepts above the prior highs, then you are in squeeze territory and you should assume gap risk in disorderly conditions. That's where the real pressure starts. Now, the two-scenario lens, because this is the credibility anchor that keeps you from becoming a hype addict. Scenario 1 is the controlled pullback and retest. In this scenario, the market digests the parabolic move, leverage gets washed out, price revisits a support shelf, think the 70s or even high 60s, then grinds higher as physical demand and institutional reallocation keep bidding dips. Confirmation in scenario 1 looks boring but powerful. Pullbacks get bought without the premium collapsing, spreads stay tight enough to hint at immediacy value, and price makes higher lows over days rather than minutes. Invalidation in scenario 1 is not one red day. It's structural softening. Premiums compress meaningfully, inventories rebuild in the stressed region, and the term structure relaxes as availability improves. Scenario 2 is the continuation squeeze. In this scenario, the flush you saw today was not the end of the move. It was a margin-driven reset that hands supply to stronger hands, and then the market rips again because the underlying physical bid and risk constraints do not go away. Confirmation in scenario 2 looks like this: quick reclaim of key levels after sell-offs, explosive upside on thin liquidity sessions, and physical signals that stay stubbornly tight even as paper traders scream bubble. Invalidation in scenario 2 is a failure to reclaim and hold reclaimed levels. Price repeatedly spikes and then bleeds, and the physical tightness narrative stops showing up in the data and the street symptoms. Both scenarios can be violent. Both can trick you. The difference is what the non-headline signals do, and that's where the real pressure starts. Now let's talk about the institutional behavior piece without pretending we can see inside every book. Institutions are not a monolith. Some chase momentum, some hedge, some allocate slowly, some are forced to rebalance by mandate. What matters is how their incentives interact with the calendar. At year end, a lot of books do not want unlimited tail risk. Silver in the mid-80s with double-digit daily swings is tail risk. That encourages volatility control, selling, hedging, reducing. That is a short-term headwind. But it can also create a paradox. If volatility control sells into a market where physical demand is inelastic, it can transfer metal exposure to hands that won't sell back easily. That's when the next leg becomes sharper. And then you get the reflexive loop. Price up forces more attention, more hedging, more reallocation, more procurement urgency, tighter spreads, higher premiums, price up again. Reflexivity is not magic, it's feedback. And silver is one of the most reflexive assets on earth because it's small, levered, and straddles industry and investment, but that's not the part that matters. The part that matters is the one metric everyone must watch if you want to know whether price discovery is really migrating. Watch the divergence. Watch whether the regional premium in Asia stays elevated or widens during Western sell-offs. If Western paper selling can't crush Asian physical pricing, that tells you who the marginal price setter is. Because a real price setter is the buyer that refuses to disappear when the screen goes red. A real price setter is the place where metal clears regardless of drama. And if that's Asia right now, then London is not gone. It's simply no longer sovereign during stress. And that's the quiet shift. Now, about the scary phrase, London lost control. Don't interpret it as a single villain, a single switch, or a single announcement. Interpret it as a gradual loss of monopoly on meaning. London can still print a reference price. But when a consuming region and its financial ecosystem develop their own gravity, local pricing, local settlement preference, local inventory constraints, the reference price becomes less authoritative. And when that happens, you can get two things at once that confuse people. You can see London vault holdings rise on paper while the market still feels tight because metal can flow into custody for reasons that are not abundance. It can flow in for collateralization, for ETF creation, for strategic positioning, for arbitrage staging. Those are balance sheet motives, not availability for sale. That's the hidden detail again. Inventory totals are not the same as deliverable float, and the market trades the float, but that's not the part that matters. The part that matters is how you manage risk in a tape designed to punish certainty. Here's the viewer psychology shield, and I want you to take it seriously because the biggest losses happen when the thesis is right. 1. Assume volatility will whip around violently even if the structural story is correct. This is not optional. If you size as if the path will be smooth, you are donating. 2. Separate trend signal from noise. Trend signal is persistent strength above key zones, stubborn physical tightness, and spreads that suggest immediacy value. Noise is intraday spikes, dramatic headlines, and social media narratives that swing from euphoria to doom in hours. 3. Beware of leverage in a market where margins can change overnight. If you can be forced out by a margin hike, you don't own a position, you rent it. 4. Don't let one candle rewrite your identity. The market will try to make you feel stupid for buying, then feel stupid for not buying. That emotional oscillation is the harvest. 5. Commit to a plan before the next spike. Define what would confirm your thesis, define what would weaken it, and define the level where you admit you were early or wrong. If you decide those things after a 10% move, you're not deciding, you're reacting. And reaction is how volatility uses you. But that's not the part that matters. The part that matters is the near-term checklist, the what to watch next, that turns this from entertainment into edge. Over the next 1 to 2 weeks, watch for these practical signals in whatever data you can access. Does the Asia premium persist during pullbacks, or does it collapse the moment paper sells off? Do regional exchange inventory reports show tightness or rebuilding? Does borrowing tone in the physical market feel constrained? Do you see talk of higher lease borrow costs or reluctance to lend? Do front-month spreads remain firm relative to deferred months, hinting at immediacy value, or do they relax as supply becomes available? Do industrial comments and procurement behavior show urgency, or do they go quiet? And on the chart, watch whether silver can hold and reclaim key psychological zones after flushes. If it keeps doing that, it's telling you the dip is being absorbed by buyers that are not momentum tourists. If it can't, then you likely move into a longer digestion phase, and the power shift story becomes slower rather than explosive. Either way, you win by not being emotionally hijacked. Now for targets and invalidation in a way that respects uncertainty. In a base case where this is a controlled retest, the market can spend days carving a messy range between roughly the low 70s and the high 70s, then attempt another push toward the $80 to $84 zone as liquidity returns and forced selling exhausts. A clean acceptance above the prior highs opens the door to the upper 80s, and from there, the $90 handle becomes a psychological magnet. But do not treat magnets as guarantees. They're potential energy, not destiny. Invalidation for the near-term bullish structure is not a scary headline. It is a sustained loss of the post-breakout shelf. Think a failure that holds below the key psychological zone around 70 and then fails to reclaim it, combined with physical signals that soften at the same time. If premiums compress and spreads relax while price loses structure, the market is telling you the stress is easing and the shift is less immediate. If premiums stay elevated and spreads stay tight while price chops, the market is telling you the stress is real and the battle is ongoing. And that's where the real pressure starts. Finally, here's the subtle truth that keeps sophisticated viewers grounded. Even if price discovery is moving, the transition will not be linear. It will be contested. The old center will remain influential, especially in paper markets and benchmark conventions. The new center will assert itself through settlement preference and physical urgency. You'll see convergence days and divergence days. You'll see pullbacks that feel like betrayal and rallies that feel like vindication. The goal is not to predict every tick. The goal is to read the mechanisms that don't lie. Premiums, spreads, inventories, and forced behavior. That's what institutions watch when they're not performing for cameras. If you want to be in the top slice of retail investors, the people who survive and compound, you adopt the same habit. Watch mechanics, not narratives. If you're the kind of viewer who wants logic over hype, you already know what to do. Stick with the community that tracks the plumbing, not just the headlines, because the next 2 weeks are going to test conviction and reward clarity. And when everyone else is staring at the screen, remember this. The real price is the one that clears where the metal is needed, when it's needed, in the form it's needed. If that's shifting east, the market can't unsee it.